Well, good morning, everyone. We'll get started, and as people join in, we'll try and bring them up to speed. But thank you very much for joining us this morning. On behalf of APPA, I'm pleased to welcome you to our members-only briefing on the potential impacts of the US tariffs and the US-China trade war that's going on at the moment in both, and their impact on the AU and NZ markets. The aim of today's briefing is to provide you with insights and information that you can use when making decisions for your business. And a thank you to those of you who shared your concerns and questions prior to the briefing. I've passed those on to Evan, who is our presenter today, and he's going to endeavour to address those throughout the presentation. As I just mentioned, joining us today is Evan Lucas. Evan's an economic futurist and a behaviouralist. And if you didn't meet Evan at our conference last year, I'll give you a bit of Evan's background. Evan's a leading voice in the intersection of money, economics, and human behaviour. He's passionate about making the complex simple, and he helps individuals and nations make better financial decisions. Over the past 18 years, his expertise has taken him across the Netherlands, the UK, and back to Australia. He's a familiar voice on major media platforms, with weekly hosting on ABC News Brekkie, Sunrise, The Today Show, The Project, and Sky News, as well as having several stints on SBS's Insight and as the co-host of Channel 10's The Brighter Side. If during the presentation today you have any questions for Evan, just drop them into the Q&A section and I'll monitor that and I'll make sure that we cover those as we go along. But at this point, it's my pleasure to hand over to Evan.
Thank you for that, Mark. That's a very, very lovely introduction. And hello to everybody out there. Again, thank you to APPA for having me on. It's an absolute pleasure to be back. I loved doing my keynote last year at your major conference you had in Melbourne. It was one of my favorite of the year. So I did actually sort of ring Mark up and have a chat to him about, how your members are going, what's going on. And he came back very quickly and said that you guys have a lot of questions. And that's probably the way that I would answer where we are. I did originally endeavor to try not to have a presentation, but it would be remiss of me not, because a lot of your questions were around what is going on in the US, what it means for your business, what it means for particularly things that affect your business, being product businesses particularly, so exchange rates, Aussie dollar, Kiwi dollar, changing trends, changing habits. So I did put a little bit of something together. So I'm going to share that now to bring that up, and I hope you can all see that in terms of where it is. And I've been a little bit facetious because as I was talking to Mark and Nadi before I came on, I actually get to do something I normally don't get to do, which is that I actually get to give you a pop culture reference to start, and therefore as a kid that loved sort of B-grade pop culture movies, this is absolutely up my alley. So I wanted to start with this piece to give you a basis about just how nuts things are.
In 1930, the Republican-controlled House of Representatives, in an effort to alleviate the effects of the, anyone? The Great Depression, passed the, anyone? A tariff bill, the Hawley-Smoot Tariff Act, which anyone raised or lowered? Raised tariffs in an effort to collect more revenue for the federal government. Did it work? Anyone? Anyone know the effects? It did not work, and the United States sank deeper into the Great Depression. Today, we have a similar debate over this. Anyone know what this is, class? Anyone? Anyone seen this before? The Laffer curve. Anyone know what this says? It says that at this point on the revenue curve, you will get exactly the same amount of revenue as at this point. This is very controversial. Does anyone know what Vice President Bush called this in 1980? Anyone? Something DOO economics. Voodoo economics.
So I needed to start there. And if you don't know what that is, that's straight out of Ferris Bueller's Day Off, which was the Matthew McConaughey, basically movie that made him. What is and why I wanted to show you that clip is that it is actually pure fact. despite the fact that it's in obviously a fictional story and the whole thing's there, and those students are sitting there completely just staring into the blank, or as you saw that kid falling asleep and dribbling out of the side of his mouth, what he explained was exactly what happened in the 1930 Holy Smoot Tariff Act. They did actually bring it in. They did raise tariffs in the States, and it did the complete opposite to what it is. So therefore, this came out of the FT. The FT at the moment are absolutely on fire with what they're showing you around what Trump is bringing. And I'm sure the reasons I've got the questions that I have and what we're about to go through is that what he has done has brought a level of uncertainty that we basically haven't seen in living memory. I mean, it's, as you can see from this chart, it is higher than the peak of the GFC and also the peak of the global pandemic. It's that much higher. Like, if you look, the GFC, which was for us in our world, particularly in product, particularly when credit was slowing down, particularly when flow of goods got hard, the outlook of flow of goods, currencies went all over the shot. That doesn't really even register on this chart about how much of a problem the GFC was and everything in between. Trump is off the chart with where this sits. And that is why at the moment you've got this uncertainty, because you genuinely don't know. And so from American, they need to know
if
that
you take your credit card and you go shopping and you run up a large credit card debt, you're running a trade deficit with all those shops. Now, it would be pretty strange if you then blamed all the shop owners for having sold you all those things. You're ripping me off, you're ripping me off, you're ripping me off, I'm running a trade deficit. That is the level of understanding of the President of the United States. The trade deficit does not represent at all trade policies. It represents spending relative to production or earnings. We call that an identity. I teach it in the second day of my course in international monetary economics. Trump never made it to the second day.
So again, that is Jeffrey D. Sachs. He is one of the most famous economists at Harvard in the US. And he's laid it out exactly why the uncertainty is there. It's because there's this whole concept that the trade deficit that the US runs with pretty much most countries is a policy issue rather than what it really is. And you guys get this better than anybody out there, which is that the US is spending. It's a consuming nation. And it's at the moment, yesterday we saw the data actually for the first quarter of this calendar year in their GDP feed numbers is starting to show signs of contraction because the consumer has stopped consuming. And it's off the back of exactly what Mr. Sachs just out there. So we've also just gone through the first 100 days of Trump's presidency. And I think this also for us here in Australia is absolutely key to answering all your questions, which is that the Americans now have got a level of uncertainty that is really starting to make them freak slightly out. So I'll let you read that on your own. I want to start going through some of your questions that you've sent in. And I think that's probably where I want to go and where I want to start. I'm going to stop sharing my screen for a moment and actually go through and talk about that, because a lot of the first sets of questions are, promotional products are manufactured in China. Tariffs can lead to increased costs on our imported products. That question, when I saw that first pop up, is absolutely true. But there is also another thing that's happening in the short term. And we got data from, and I'm going to pronounce this wrong, and I do apologize to the German company, but Herb Lloyd, which is one of the largest global shipping companies on the planet, just reported to the German stock exchange that they have seen not a pause, but a 30% cancellation of sea-bound shipments to the US from China. So you've now got a scenario where it's actually starting to come into real world data that shipping companies now have been cancelled, because if you think about it, it makes complete sense. If you're a US importer, and you guys know this again better than anything, you've got at the moment to pay 145% tariff on the products you import. So if you are importing 100,000 US dollars worth of goods, Once it hits the West Coast, and let's say it's probably likely to be places like Oregon, LA, or Portland, you then have to pay the supplier that 100K, but then you got to pay the IRS, the US government, $145,000 for that import. And that is $245,000 worth of goods for what is realistically only worth 100,000 US dollars. So yes, it can increase costs to the tariff user, not necessarily to us. What we're also now starting to see, and what is fascinating from a perspective that it is going to lead to changes in what China does as well, is that we are just starting to see signs that port inventories are growing. And that is also a problem for China because these are manufactured goods ready for product placement. They therefore have been through the process. There is cash flow that will start to become a problem because it's slowing down. You've manufactured the product, it's not actually being sold, it's sitting at port. You're still manufacturing products for future orders there. That product is going to have to find new homes and it's going to have to find new markets. Australia may actually therefore see a scenario that is also very interesting here, that inflation will start to come down, product offerings will start to increase because supply of product that would have gone to the US that is currently being cancelled comes here. So I think that question, a large portion of promotional products are manufactured in China. I'd actually argue almost the majority of promotional products are from China. May, in the short term, have a scenario where they actually see prices drop because you now have the products that were originally scheduled for Australia, plus a portion or some or most of the products that were originally going to be placed to the US right now needing to find a market. And so watch this quite closely. It's a scenario that is just starting to come to fruition. The other thing about May and May month as a whole, this is also when China starts to ramp itself up to make sure that it can reach whatever arbitrary GDP figure it reaches for a calendar year. This year it's currently 5%, which is what it was in 2024 as well. They're currently bumbling along. They've got deflation. So don't be surprised also if you actually see an increase in manufacturing in China to get to the GDP figures they need to do, which will then again increase the inventory that's there. So from an Australian perspective, there's actually opportunity that's presenting here. Cheaper product, high amounts of product, the ability to negotiate to help remove over inventories in China is all part of it. So watch that space very clearly. The other one and the other major question that Mark sent through me from you guys was the volatility in the exchange rate is making it difficult to quote for customers on products being imported into Australia, which the price, what will be the price in 6 months down the track? This is a problem that all international importers face, no matter what period in time. And again, I don't want you to sort of sit here and talk to you about how to suck eggs. So what is going on right now, though, that is different to the past is that when we talk about currencies in this country, you've got to remember it's a ratio. It's the Australian dollar to the US dollar. And the US dollar at the moment is doing something that traditionally it doesn't do in times of volatility. It's the one that's being sold. It's the one that's being under pressure. Because when volatility gets up, when global uncertainty gets up, where do you go? Well, the largest economy on the planet that pretty much will never default on its debt is where currency flows go. So normally, if you go back to having a look at what happened during COVID, the GFC, any form of event of that nature, the Aussie dollar tends to really fall quite hard because we are what's seen as a risk currency and the US dollar is bid up. The reason for it, again, is that currency investors and currency traders will put their money into US fixed income. And the most, under theory, secure outlet or the secure product on the planet is seen as the US 10-year bond. However, right now we have an administration that is completely destroying that whole concept. Those two videos I showed you at the start is why you have a scenario where government spending, despite the fact that Elon Musk at the moment is supposedly making up, the Department of Government Efficiency and cutting the amount of spending, the spending in the US is actually going up at the moment. And so you have a scenario where you've got out of slightly kilter policies around tax, policies around trade, a president that is making executive orders faster than we've ever seen in history. It's creating chaos, and therefore that creates uncertainty. And it means that normally that money that would have flowed to US bonds is actually the money that's being sold. US bonds are going up. It's making it more expensive for the US government to fund itself. I'll come back to that in a minute. And it's pushing the currency all over the spot. So if you had to ask me that question 5 weeks ago, the Aussie dollar was at 58 cents. The Aussie dollar currently is at 64 cents. And it's still going higher. And I'll come back to that as well. Going back to the issue with the US, what's so fascinating is the market has actually become the guardrails for the US administration. Normally, it's something like the Department of Justice, or it would be, administration overall, the US Federal Reserve. The president's ignoring all that, which is fine. That's his prerogative. He's allowed to do that. The market, on the other hand, has made what he wants to do a bit harder. And because it's made it a bit harder by making costs more expensive, he's all of a sudden backtracked, particularly around the tariff scenario for the world. We've all now just basically got a blanket 10%, not including things like steel and aluminium and a few other bits and pieces, or if you are still Canada or Mexico. But overall, that's it. The only one he's really got a beef with is China. Now, for Australia, that's a slight issue. So the currency question is an interesting one, because at the moment, the Australian dollar is moving quick. Where is it going to be in 6 months' time? I think we need to put the US dollar to one side and talk about the fact that still our major trading partners are Asia. And we need to look at the Chinese renminbi. The concern at the moment with what the Chinese are trying to do is they are trying to basically buffer themselves from the tariffs that we just discussed. And what they're doing is what they always have done in the last 40 years, which is as things get difficult, they devalue their own currency through the mechanisms that they use to try and basically buffer and offset the cost of their product. So if you actually have a look, the Chinese renminbi is declining against the US dollar despite all the chaos, because it means that when their product does get to America, because only 30% has been cancelled, not all of it, it will therefore basically still relatively appear cheap. Because if they're buying at a cheaper level from the Chinese yuan to US dollar scenario, despite the 145% tariff on it, it therefore somewhat buffers the probability that their product won't be sold once it gets to port. And that also flows to us here, is at the moment, China is doing that across the board, and the Aussie Chinese yuan exchange rate is sort of flowing through with that. It has in the last couple of weeks popped up because the Australian dollar has popped up. In the next 6 months, where does it go? Well, I would again probably say whatever China does is where the currency will go. If China is continuing to devalue the Chinese yuan, that will be the answer in 6 months' time. The next ones to look at is probably the Japanese yen. And again, why we need to go to the Japanese yen is that for a lot of particularly things like electronics, business to business products, high-end manufacturing, high-end tech, the yen is actually really interesting because the yen is still, although it has eased in the last sort of 4 to 5 months, is at or near 30-year lows. It's currently trading at 1 Aussie dollar to 90 yen. Historically, in the last 15 years, it's been more likely 65 to 80 yen. So Japanese products are cheap. It explains also why last year, the number one destination for Australians and New Zealanders for holiday was Japan, because it's never been cheaper for Australians and Kiwis to go to Japan with the currency exchange rate that it is. Do I expect that to change in the next 6 months? Not by much. At the moment, Japan is pretty happy with where its currency is, because for the first time in also basically sort of 29 to 30 years, as an export nation of high-end products, their goods actually are competitive because their currency is cheap, and they're actually starting to see themselves get out of deflation for the first time in about 15 to 20 years. That will continue because the Japanese government and the BOJ, which is the Bank of Japan, wants that to continue. So if you do trade in that, just be reminded that that's probably where we sit. Now, I need to go back to have a bit more of a show about what is going on in the US. So let me just take you back to my screen. Mark, there isn't any questions at the moment, is there?
No, I think everyone's doing what I'm doing and taking lots of notes. So not just yet.
Right, cool. just staying on the currency and staying also for those of you that are over in our lovely sunny isle to our right over in New Zealand, this also fascinates me as well, is that what I'm going to talk about towards the back end of this is that don't forget, I'm a behavioralist as well. And part of what is going on in product, which I'm sure you're starting to hear and see from suppliers, but also see and hear from your customers, is that Trump's policies and Trump's actions are changing behavior, whether that's good or bad, in terms of some of them will see it as good reasons to be changing their behavior. Some will be saying it's not why I'm changing their behavior. But this caught my attention in the fact that you look at year-on-year visitors to the US by country of origin. This is a snapshot of obviously European countries. It's not just Europe. It is happening across the board. There is an opportunity here, particularly for heavily reliant tourism/travel nations. New Zealand's a great example of that. We are as well, but not as heavily as New Zealand. These nations don't stop traveling. They don't stop moving. In fact, if you look, the Germans, the UK, and also Spain are in the top 6 to 7 nations of travelers. Australia also is one of those as well. But those people that were going to head to the States, they're going to find elsewhere. There is an opportunity to be basically moving towards the idea that the US and US sort of traveler at the moment is talking about escapism and getting away from the Trump administration. They're looking for places. And then Europe at the moment, a normal trip across the Atlantic is not happening. They will want and need to find new markets. And there is product opportunity here. There is no doubt that Europe will be the part of the world that I think will be one of the most interesting reactors to this. They are being really hit hard by the tariffs. There's no doubt that the president has made his view about them pretty strong, which is that he's not a massive fan of what has happened in Europe. And that will change behavior. That will change culture. It will change society. It will change, perception. And that's all part of it. And that therefore has already seen changes from an Australian-centric point of view, that we've already seen the EU come back and start to engage on the idea of a free trade deal, something that sort of froze up over the last 2 or 3 years. They're now very, very willing to start talking about it and showing signs that not only are they talking about it, that the action is starting to come about. And that, I think, needs to be put there. Because the other thing that I found really fascinating is, don't forget, human beings, this is the number one thing from a behavioral perspective that they want. They want the ability to have the feeling that their life is, and activities and habits are self-chosen and self-endorsed. It's why you do the businesses that you do. It's why you work in the industries that you work in. You are trying to achieve what most people are trying to achieve personally, but also through their business, is autonomy. And they're having that impacted, and quite significantly impacted, by what they do and by a change in basically what is a flawed theory to try and bring 1950s, 60s America Renaissance back to 2025. And that's basically what Trump is trying to do. I mean, he has this romanticized version of what the 1950s and 60s manufacturing of the US was like. The fact that they were manufacturing cars and high-end products, that people had a level of employment that was, much, much higher / slightly more secure than it is now. And basically you could earn a decent wage making something you could. What he forgets is that actually during the 50s and 60s, US manufacturing was in decline. In fact, it was rapidly in decline. It was after the Second World War. The Second World War was basically the peak of US manufacturing. And then other nations started to get cheaper at it and much more, experienced at it. The example there is Japan. I mean, we forget Japan now is seen as one of the highest manufacturing nations on the planet. But in the 50s and 60s, they were seen in the same equivalent as China. And look at them now. The US manufacturing story that he's trying to sort of manufacture, excuse the pun, it's gone. And it can't be returned. Because the other thing that's there is that, do the Americans actually want to do that? If you put this theory, this autonomy theory, to the average American worker, do they want to be manufacturers? Do they want to actually be working in that space? The majority will say no. And they have really no interest in going into it. It's not what their society, their culture now really values. It's things like digital. and digital investment. It is looking at things like AI. It's looking at things like crypto. It's looking at things that expand the services that they've been offering to us for the last 25, 30 years and have done it incredibly well. You have to look at players like Meta, Google, Amazon, Apple, Microsoft, all of the above. It's sort of lost in this whole debate and where we sit, because again, this is what's driven people in America to do what they now do. It's what drives us here in Australia and in New Zealand to do what we do. We love the autonomy that we have and the things that we offer. And I think that's been forgotten, because the other thing that's fascinating about it is that how much money is actually spent by the US into products coming out of China. So this is a little bit of a bubbly chart, and I excuse the pun, but I wanted to show you the kinds of products and how much money Americans spend on manufactured Chinese goods. And the one there on the far right-hand side is smartphones. It explains why 2 weeks ago, the president very much backed away from the tariffs that he put on Chinese goods for particularly China manufactured smartphones. Because if you are talking about $41 billion of smartphones imported with 145% tariffs on them, that's incredible. It'll also therefore slow it right down. The margins on smartphones is not enough to be absorbed. Somebody was trying to have a debate with me about, something like shoes, for example, where, they're only made for $8 to $16 a pair and sold for $80, so they can absorb it. That's true. That's fair. Smartphones can't do that. Things like computers, they can't do that, because the margins in them are very, very small and the turnover of them in them is high. And that's why, the whole concept is you win by buying less. Is that what he's trying to do? That you need to basically stop consuming? I mean, that's not what he wants at all. He just wants it all done in the US. And then the next one to have a look at that really caught my attention was this incredible piece of data that was in the New York Times, straight out of the US International Trade Commission, is just how much household goods are manufactured in China and where they're from and what parts that the average American household needs. And as product providers of what you do, you'll know this. You will know that if, for instance, you are trying to get particularly an apparel item, particularly a stationery item, particularly things that are for, the home under $500, it's more likely than not to be manufactured and made in China. And the other thing about it is that in the last 30 years, the quality has gone exponential. I mean, if you compare what you were getting out of China in the 90s and the early 2000s to what you're getting now, it's a level that we couldn't manufacture here, no matter how hard we tried, at the same quality and at the same cost. It's simple economics 101. It's called economies of scales and efficiency. And that's what China has done very, very well. The problem it's now facing is, like any maturing nation and any maturing economy, is that it has a very, very large middle class that it too wants autonomy. It too wants to be moving towards what most advanced or advancing economies does, which is a knowledge-based economy. So the question really for China also is that, despite what I've just shown you on screen and the share of US imports that it has, is that does China start having to face competition from other players? It is. You look at Vietnam, you look at places like Bangladesh, there are parts of Africa that are moving in this direction as well. That will be the other part of the question and the discussion going forward. Right, I'm going to go back to some of the questions because I've done my little dash on the China story and the US Lova story. So I've just spoke about China. So one of the questions was, will it affect the prices of all goods suppliers get from China, since trading currencies we use mostly is the US? So this was getting back to that currency question before. And that is something that we need to be aware of. Yes, most of the exchange products that we use in Australia is in US dollars. It's not in Australian dollars. There was a period a couple of weeks back where I was concerned that the risk that's going on globally was going to see the traditional risk movement towards, the US, towards places like Switzerland, and therefore would see the Australian dollar devalued, and therefore it would cost us. And there was an issue, and even the RBA was worried about what we refer to as importing inflation. As the currency falls, therefore the product that we bring in obviously will be more expensive, and we therefore have to make that up by rising prices to cover the cost and therefore still make margins on what we do. That's flipped. and we can see that the currency is actually appreciating. I would say this though, it will moderate sooner or later. The US scenario and the chaos will slow down, and then it will go back to what I refer to as normal exchange rate fundamentals, which is that you need to remember, why is money moving around the world the way it is? Most of it is investment banks looking to find small margins of basically coupon payments. And by coupon payments, I mean interest payments. So if you are able to get a slightly higher coupon payment for the Australian 10-year bond over the 10-year US bond, US investors tend to sell their US dollars, buy Australian, and invest in Australian government bonds and then send it back. That tends to be what happens. The thing that's going to probably happen in 2025, and I'm coming to the next part of what I want to talk to you about, which is an Australian-centric, New Zealand-centric point of view, is that over this year, it is very, very probable that the RBA will cut rates 4 times, possibly 5, by Christmas. And it's a good thing. It needs to be seen as a good thing, because we have, unlike what's going on globally and unlike the uncertainty that I'm having to sit here and talk to you for half an hour before I want to talk about what I really want to talk about, is that the Australian economy, although it's not absolutely booming or really showing confidence that we want to see, it's doing okay. In fact, it's doing probably more than okay compared to global peers. Is inflation back in target? It's getting close, and I'll come to that in a minute. But overall, we've managed to do what we normally do in this lucky country of ours. We tend to be fairly laid back about what we do. We are controlled and fairly, strong in our views that taking a slow and steady approach is what we did and what we do. We did that during the GFC, we did that during COVID, and we've done that in this inverted commas cost of living crisis. The RBA, some people will still debate to you, have not done the right thing, but overall, if you look at how they've controlled the last 3 years since they got caught talking about the idea they wouldn't move rates to 2024 and they started moving rates in the end of 2021, 2022, has realistically done pretty well in terms of moderating the overall scenario around inflation. And on that, let's sort of bring that, because yesterday we did actually get the inflation data, and that inflation data was as expected. So let me show you what I mean by that. So this is yesterday's inflation data for the first quarter of this calendar year included. For the first time since 2021, the figure that matters to the RBA, which is referred to as trim mean, so that's core inflation. It takes out the top 15% items and the bottom 15% items, the ones that are the most volatile, and gives you a core measure. It's back inside there, what they refer to as their target band, which is the 2 to 3% you keep hearing about. That is the figure that matters to them, because as you can see by that chart, the really thick blue line, the headline CPI, it moves really quick and can move on external factors. Energy is a great example. When unfortunately we did have the wars that kicked on over in the Middle East and over in Ukraine, it really racked up energy prices quite quickly. Or for instance, when we've had drought or cyclones or flood that have knocked out food and caused fluctuation in food prices, that moves that headline CPI figure quite quickly. That is something the RBA does not want to be basing its decision making off. Because if it was doing that, it would move policy real too quick, too fast in both up and down directions, and it would basically make your job and my job very, very tricky to be budgeting for. So that's why they use trim mean, and that's what's there. And so it is back into target. Some people will tell you that it's still above what the RBA wants. That's sort of forgetting one thing. This is the first quarter of the calendar year. The RBA is forecasting by June, by the end of the financial year, that the trim mean figure will be at 2.7%. That, on all things that we saw yesterday from the data, is absolutely on trend and absolutely likely to happen. And that needs to be the basis of what you're thinking. So there is real positive. That whole issue around inflation that you guys have been facing over the last 2 years, that ginormous spike that you can see on that left-hand chart, it is returning to trend. And the RBA is starting to feel a bit more confident about what it's doing and where it's going. It also brings me to the chart on the other side, which is tradables versus non-tradables. Again, some ridiculous economic term, and I do apologize for it. But the reason I need to show this to you is that you guys fall into the yellow line, the tradables line. Tradables inflation are those items, services, and goods that you can get in Australia or New Zealand, but also internationally. So it means that the products that are tradable, that are inflation exposed, are international in nature. If we import TVs, manufactured TVs, solar panels is a great example, considering the political angle that that's taking on. Those are tradables that have tradable inflation. And you can see that particularly tradables, that has actually been not only below the target band of 2 to 3%, it's basically not growing. It's at 0.9 of 1% per annum. The issue has been non-tradables. That is things that can only be done inside a country. They normally are things like government services, things like education, things like health that you can only get in the nation. You can import pharmaceuticals, that's inarguable, but that's tradable. That's not healthcare. You can't import healthcare. You can bring in education from overseas because you can do it online, but to go to a university, to actually physically go, you have to go to it, and education is there. And those two, particularly education and health, are two concerns, and why non-tradables still sits at 3.1%. But overall, the trend is good. The trend is there. It is declining. But for you guys, it's that bottom one. And that question before about what is it, are we going to see an increase in cost because of what's going on with the trade war? What does it mean for China? Well, you actually, as I said, you may now actually see tradables start to go into deflation, which is where prices decline, because China has a production problem and it will need to find new markets. Next part to look at is just the overall categories that are and where we have been to where we are now. So on the right, starting from the right, it is the second quarter of 2020, all the way through to the last piece of data that we just had yesterday, which is Q1 2025. And you can see that overall across that band, it's getting back to target across the areas. You'll be able to find your own, space that you operate in, whether that is things like audiovisual for recreational culture, whether that's in things like, particularly medical products, or whether you deal with apparel, whether you deal with food, retail, etc. All of that's there, food and clothing. What I do want to show also is there are things in there that are slightly out of kilter. Now, I'm sure you can probably and immediately get your eyes drawn attention to the orange squares, because natural human being behavior is to look towards the negative. The one there straight away that everybody asked the question, what the hell is going on with tobacco? I'm going a little bit off target for what you guys listen to, but tobacco is an interesting one, because if we get back to tariffs and to levies and to those kinds of things, tobacco is the Australian version to really point to. Why? Well, we've got the tobacco excise. Now that, the government will argue, is not a tax policy, it's a health policy. It's designed to try and make, basically tobacco products so expensive that you don't smoke anymore. The catch is that we have now created Australia's own version of prohibition, because it's now so expensive to buy a packet of cigarettes that you've pushed the behavior, again, the consumer, that person that wants the autonomy to choose what they can, to the illegal market. It's also, from the illegal market's perspective, if you're organized crime, a much, much cheaper, much legally less nefarious way of doing business than you are with other forms of narcotics. I mean, the time that you have to serve for dealing, basically contraband tobacco products versus the time you have to do with high-end narcotics is chalk and cheese. And that's what we're seeing with this. So again, if you look at that from the tariff perspective and think about where tobacco sits with tariffs, they are going to push people to do things that are different. So the next question that one of you guys asked out there, which I thought was fascinating and brilliant insight, is that does Australia take advantage of the fact that we only have a 10% tariff with the US versus the 145 with China? Yeah, that's a possibility. In fact, we know that happened in the first Trump administration. We actually saw Chinese businesses starting up businesses in Australia, importing their products that would have gone to the US here, and then exporting them from Australia to the US and paying the tariff that we have. Because overall, despite all that additional transport, despite all the additional setup costs, etc., it actually ends up being more beneficial. Now, that is a bad behavior. I want to point that out very, very clearly. That's a bad behavior. But that's what's going to happen. That's the reaction of what we're likely to see. And the catch also gets back to some of the questions before, is that therefore means that we might miss out on that possibility of having cheaper goods, because instead of it actually coming here and staying here and being sold by you guys to your business B2B partners or your B2C partners, it completely circumnavigates us completely. So our government needs to be on to that. But again, it shows that even our government is and can be open to problems like what I just discussed, and can find themselves being caught in the crosshairs of missing out on opportunities. It's not just about, you know, dumping, which is what I've just explained from China. I mean, at the moment, the other discussion is multinational digital companies from the US that don't basically pay enough tax in Australia, because how do we tax it? That is all part of the debate going forward and where we currently find ourselves. I'm going to go back to here because I want to keep making sure that I answer your questions. And I realize, Mark, I do apologize. I've rambled more than doing what I was supposed to do, and talk about that. Is there any questions before I go back?
Just one. You just sort of touched on that potential for lower prices, but equally, you mentioned earlier on about shipping rates have been cancelled.
Yes.
By about 30%. So will there be an opportunity for members to negotiate better shipping rates, and will there be an availability of shipping to support them in buying cheaper stock and getting it to Australia or New Zealand?
Yes and yes. Short answer. So at the moment, I mean, if you look at what Herb Lloyd were talking about, is that they too now have a scenario where, you know, a consistent trade perspective. Let me put it into another way. 14% of all Chinese exports went to the US. That's an incredibly large number of exports. And if you've got 30% less of that 14%, that's a problem for your turnover as that shipping company. It therefore means you have the other issue that they face, like all things in that area, things like aviation as well. The more time their ships sit in port, the more rent rack up they have. So, you know, they want their ships to be in and out, just like an airplane wants to not basically be on the ground, because every minute they're on the ground, they are charged by the airport. It's the same with the ports. So they at the moment are in a, what would you argue, a seller's market in terms of where they sit, that they want their product on and actually on sea. So they're not paying, you know, basically standardized shipping costs above and beyond what was expected, plus product that is now just building up and sitting on their ships. So yeah, there is an opportunity to do that. Again, I'd always, you know, be delicate about it. There is also opportunity to maybe look at blending it and saying, right, we could offer a, you know, 4, 6, or even 12-month deal of shipping at a current discounted rate that over the year would mean it could be 10 to 15% cheaper than doing it, you know, once or twice or basically ad hoc as required. So that is certainly something that you can already hear the shipping companies are talking about. So Hamburg is the next one to watch. They report in about a week's time. Are they saying the same things? That will be fascinating, because Hamburg is one of, if not the largest shipping container provider out there and shipping provider. It's going to be something to watch really closely. And for an economic nerd like me, this is the stuff that you learn at university. This is the theoretical stuff, but you guys live and breathe it every day. That when you have some form of global shock, what does it do to supply and demand? How does the supply and demand get around it? What is the natural world action? All of that is what we're talking about right now. And from your business perspective, two things to take home so far. First, global order is being distorted. That's one. There's an advantage to that. Two, the Australian and to some extent the New Zealand market is actually still relatively stable. The Australian consumer is still consuming. The Australian business is still moving along pretty much as it was even before Trump started throwing his mud around and doing what he's doing. We only have 4% of our trade with the US. So we've got to put that into perspective. The direct impact of the tariffs on us here is pretty low. Directly. Indirectly, it's a different story. But overall, we are most likely importers of product, and particularly you guys watching are importers of product, particularly promotional product. There's opportunity that's really presenting to take advantage of the chaos that, you know, the US finds itself in that we are not in. I'm just going through the questions. How
When you and I chatted earlier, you also mentioned that the New Zealand response to bank was more aggressive. So maybe for our Kiwi listeners, if there's a couple of points you've got there.
Yeah, so it's a harsh thing to say, and I'm really sorry to my friends in New Zealand because I love coming to your country and I have a lot of Kiwi friends that live here in Australia as well. The RBNZ is probably what's referred to as the wild, wild bank of the Far East. And historically, it has done things to align with policy that's slightly against what most nations would do. So if we look at what's happened in the last 5 years, the RBNZ has been one of the banks that went harder, faster, and stronger than any other major central bank and raised the cash rate equivalent to above 5%. Compare that to Australia, where we maxed out at 4.35%. It's also therefore got to a scenario where it probably actually seized up everything so much that it was partly caused the recession that we've just seen in New Zealand. So they've now got cash rate cuts coming at a rapid rate of knots. So 0.5% down to go with the 0.5% ups that we saw during 2022 through 2023 and a half. What I would probably say is this: New Zealand will come out of it. It will come out of it a little bit more bruised and battered than it probably needed to. You do now have a new central bank governor. Your previous governor in Adrian Orr was known as shock and awe for a good reason. He's no longer there, which I think is a positive. So the stability is getting back to levels that you would want over there. It's the stability and demand for New Zealand products, particularly agricultural products, is going to be stronger and going to be better. I mean, at the moment, the US was a big, big player in New Zealand, and they probably will be even more so now because they can't manufacture or import some of the goods that New Zealand can do so cheaply. They may actually come and get it directly with lower rates, a better exchange rate. I mean, the Kiwi US dollar at the moment is at the lower end of 50 cents. That's attractive. So again, you've got a currency that will appear cheap internationally. The catch is that importing stuff is slightly more expensive. But overall, the bad time is done. Like the harsh work and the hard work that the central bank has put you through is over. And the outlook for New Zealand in 2025 and particularly 2026 is much, much better and much, much cleaner than it probably was. However, and it is unfortunately a however, you will get swept up in the fact that coming out of any recession, no matter where, how, when, or if, is always slightly difficult. And there will therefore be customers that were there beforehand that unfortunately have disappeared because of the period that you've just been through. That's a bit in between. Sorry, Mark. And I do apologize to my Kiwi friends, as I said, but it has been a fairly tough period. I know that having been over there last year, you can feel it, but it is going to get better because finally the crushing effect of interest rates will come down and will come down quite hard. I think I need
Yeah. So I'll just do a bit of a time check. We've probably got about 2 or 3 minutes left. So if there are any sort of key points you want to get across to both
so I should probably
that would be great.
So this is the rate expectations from the RBA. So we just talked about the RBNZ. Let me talk about the Australian one. In fact, I'm actually going to bring up this one. Sorry, guys, unprofessional. This is the expectation of rate cuts in Australia as of last night and after that CPI data that I just showed you. This one here is the one that matters, which is where the expectation of what the rates will be, the cash rate in Australia will be by the December meeting. It is now moved below what was expected, which yesterday was sitting at 3.08. So that was basically saying by Christmas, it's a near certainty that 4 rate cuts will happen this year. It's fallen further, so it's now at 2.98, as you can see by that. But what it's showing is that we are going to have a fairly strong, steady decline in cash rate cuts. It won't be, as I said, a big sort of shock hit of 0.5%, but at the moment, the expectation is 96% that you'll get a cash rate cut of 0.25 of 1% in 20 days. It's then very, very likely that come August, September, and then the November meeting, that you'll get a further 3 more on top of that. And then leading in through 2026, there's probably 1, maybe 2 more. So if you think about the cost of, the best way to put it to you, at the moment, on the east coast of Australia, the average mortgage size is just on or under $750,000. It's a lot. But if you were to take the monthly average cost that will take out of that mortgage per month, it's upwards of about $1,500. That's a lot of spare capacity cash in people's back pockets rather than being in the bank's pocket from the cash rate cuts. There is therefore a pretty decent outlook for particularly consumption, particularly for business expansion, and particularly for confidence in 2025, despite everything that Trump is doing right now. It will slow down. He has to. He's already shown signs that he can't keep going at the current rate of knots that he's doing. The market's already catching him. So if we put him to one side and all things being equal, products in 2025 are facing, tailwinds that we haven't seen pretty much since before COVID, which is that we've got a falling cash rate. We've got people that have been basically sitting on their hands trying to save and keep their mortgage afloat that's about to start having less pressure, and then also knowing full well that they need to start moving forward. It's a really interesting and probably positive period of time, in my view, to where we sit. And it's hard to say that considering everything that's going on. What is going on at the start of 2025 will be studied for years, and there's no doubt about that. But we forget that if you actually have a look outside of the US, most things are moving in the right direction, and Australia is one of them, as well as New Zealand. And that's why I think this year will be much, much better than most people believe or have felt so far, because we are clearly going to go through a period that we were expecting to happen anyway before the President of the United States got a little bit uppity.
Okay, so I think that really brings up, come back on camera. I think that really brings us to pretty much the end of the time we have allocated with you. I just wanted to reassure the members, first of all, that we will post this recording in the members only area. If you're like me, you've probably taken pages and pages of notes, and it'll be good to go back and review it in your own pace, so it really sinks in. But I think, Evan,
I do apologize. I know I raced through that, and I'm really sorry. There was so many questions and so many things to cover.
That's okay. And I think it's good because you gave sort of the broader context of where things are sitting, and then we've distilled it down to, well, what could that look like in Australia and New Zealand, which is really what everybody who was coming on the call wanted. So what I might do, if you don't mind, is just say to everyone, if there's anything else that comes up that people think, oh, I'd like to ask that question, maybe if they send them to me, I could do a consolidated list and send them through to you to have a look at.
Yeah.
And we could do that for the members. So
that I would love to do that, because not just today, but basically, I am here to sort of be part of it. If you do want to find out more about me as well, there is my details and my data. I am always happy to talk, pick up the phone, have a chat through whatever exchange you want to do. Mark's right. Please go through Mark if you've got specific APPA questions. But if you do want to engage, I'm always about, and I'm always So please don't hesitate to get on that. You can just scan that QR code if you need to.
So go on, Evan.
As I said, it's hard right now to feel positive. Like the pessimism level, as I showed from that Trump chart right at the start, they're justified for a reason. It is because there is such a level of uncertainty. He is creating that. I didn't get to go through everything exactly as I wanted to, but it's because we're doing something that realistically we haven't seen in living memory. And what he's trying to do is something that hasn't been seen in living memory, despite the fact that history does show it doesn't work. And that's why I get people's pessimism. And it is a really decent but, we continue to be in the part of the world that actually gets lucky. Being in the oceanic region, we don't have to deal with as much issues as others. Sometimes that means we don't grow as much. Sometimes that doesn't mean we miss out. But overall, we are much, much smoother, much, much more consistent part of the world than you see in the Americas or in Europe.
Fantastic. So I think we'll end on the note that there is opportunity, there is hope, but we've got a little bit of time to work through things. And I think you mentioned to me the other day when we were chatting that after an election, regardless of who wins, there's like a 4-month window of a honeymoon period after
I was about
that.
to get, because somebody asked that question, like what happens post the election? So I've still got 4 minutes before midday. So let me run through that.
Let's do it.
Which is the election in Australia is obviously now 48 to 72 hours from where we are, depending on what you want to do. And what Mark was alluding to is that, interestingly enough, in the lead up to an election, most businesses find that there's a fairly steady, slow decline of business. Things get really quite slow, and I'm sure you're feeling that right now. It's because actually when the election happens, we are on a pause. We don't know what we're going to get. Are we going to get the incumbent? Are we going to get a new government? Are we going to get a change of direction? Again, uncertainty is what an election brings, and particularly when you get a 6-week election like we have rather than a short 4-week one. But barring Kevin Rudd, who ran into the GFC, every single prime minister from John Howard to right now Anthony Albanese, any color persuasion, doesn't matter, they get a 4-month holiday of where things actually improve by between 2 and as much as 7% in. And that's what I think you also need to sort of start to think about, is that there's a double whammy there. You're about to have the election and getting that honeymoon period where people know the certainty. They don't have to think about voting for another 3 years. The policies that they voted on as a nation are now locked in for 3 years. They're not going to change. All that's great. You know what the government's going to do. That's going to happen for the first 4 months, starting from basically, May, because the election's going to be on the 3rd. During that same 4-month period, rate cuts are going to happen. And their rate cuts are a slow reactionary drag. So the rate cut that we're probably going to get this coming month will start to actually hit people's pockets and matter pretty much as that 4 months starts to just wane off. So that's the other difference, is that you've got this second wave kick, is that you've got the election getting done. Your phones should start getting calls once the election's done, knowing what's going in. Even with a hung parliament, I still think we're going to be fine. And then you're going to get the trailing effect of interest rate cuts coming through at the end of next year, end of this year, and to start 2026.
Okay. What we'll do is we'll put a note in the diary and come back to you on that.
Yeah, correct.
All right. Well, thank you very much, Evan, for your time today. It's very much appreciated. There was so much to take in, and that will help people going forward. I've already had a couple of questions behind the scenes, just confirming that, yes, it will be in the members area of the APPA website, so you can go back and have a look at it. But yes, as I said, thank you very much for joining us today. And, if members have got questions, they can send them through and we'll take it from there.
Again, thank you so much for having me, guys. It's been an absolute pleasure to present to APPA again. There is an article as well that I've agreed to do, so I will get the article done that will come out in your APPA presentation material in the next couple of months, if I remember. So,
just two more posts from people. Fantastic presentation. Thank you so much. An awesome presentation. Thank you. So we're getting some good feedback through. So thank you again.
Thanks, guys. Have a great afternoon and good luck for the rest of the year.
Yeah. Thank you. See you.